Today, we have Mr. Peter Schiff, CEO of Yuroperši픽 Funds, as our guest for the interview. Mr. Schiff, thank you for joining us.
All right. Thanks for having me on.
In Korea, you are well known as a Bitcoin skeptic, but one of the reasons we pay attention to you is because you are an insightful economist who predicted the global financial crisis of 2008. What was the logic behind your prediction for the global financial crisis at the time?
Well, I understood the problems that the Fed had created by keeping interest rates artificially low. I particularly understood the dynamics in the housing bubble, and I knew what was going to happen when housing prices inevitably fell. I knew that a lot of the teaser rates and adjustable rate mortgages were going to reset, and I knew that people had stretched their finances to buy houses they couldn't afford. I knew that the low interest rates were the primary reason that housing got so expensive, and that fueled all the speculation. I understood the way Wall Street had collateralized the mortgages and how they were distributed to investors and how they didn't appreciate the risks. I knew that the credit agencies were missing the mark and were rating structured pools of mortgages, AAA, AA, A, when in many cases they should have been junk. I knew about the problems and the moral hazards of government-insured mortgages and financial institutions. So I could see this financial train wreck coming from a mile away. That's one of the reasons that I was advising people to short the subprime market in 2006, and I helped a lot of my clients do that. And everything blew up in 2007, and we got the financial crisis in 2008. But, you know, I was warning about that for years and years. I started warning about it in 2002. So it just took a while before my warnings, came true. But I think we have a much bigger financial bubble now, I think with much more dire consequences. And I've been warning about this one for even longer. But I'm going to be right. Just a question of when. And I think, when the markets prove me right, it's going to be, a much bigger crisis than what we had in 08.
So, do you think there are any signs of similar crisis in the United States or the world currently? If so, what are the signs?
Well, back then, there was just a false belief that real estate prices could never go down. And so a lot of bad loans were made under that false assumption. But right now, I think the biggest disconnect is regarding inflation and the widely held belief that inflation is now a problem of the past. And maybe it's a little bit slow to go away, but we're headed in the right direction. And the Fed could start dialing back the rate hikes and everything's going to be great. And that's not true. I mean, the Fed has spent more than a decade creating inflation, and we've just begun to catch up with the consequences. I think consumer prices have a long way to go up based on the inflation that's already in the pipeline. But I look for the Fed to create much more inflation to try to prevent another financial crisis because there's too much debt. And as inflation drives interest rates higher, the debtors can't afford to service the debt, and that includes the United States government. And so in order to prop up an insolvent banking system and to make it possible for the government to avoid default on the national debt, the Fed is going to go back to quantitative easing, and I believe we will get some rate cuts, but that's going to send inflation through the roof and the economy through the floor. So we're going to have a massive round of stagflation like the 1970s, only much worse.
Do you have some scenarios about how the Fed move in this year?
Well, I think this year, whether or not we have the crisis beginning in 2024, it's hard to say. They're certainly going to do what they can to keep the monsters at bay because it's an election year. And that's another reason I think the Fed will cut rates, even in the face of mounting evidence that inflation is going up, not down. But the Fed may be able to justify rate cuts if we get softening economic data, which we'll probably get. I mean, I think the economy is weak despite the data. I don't necessarily believe the data. And a lot of the data is being misinterpreted by investors. They're not understanding what the data is actually revealing about the economy. But I think it's much weaker than people think. It's inflation that's stronger than people think. But I think the economy is going to deteriorate between now and the election, which is going to put more pressure on the Fed to try to provide some kind of stimulus to help Biden win the election. Though I think that he'll more likely lose if he's the candidate. I mean, he may not be the candidate. We'll see.
Recently, pension funds like California Public Employees Retirement System are shifting money into bonds. States and local government funds are swapping stocks for alternative investments. What we're curious about is whether this is a signal that U.S. stocks are at a peak. What do you think?
Well, I think the institutions or endowments or anybody making a major allocation shift into bonds is making a major mistake. I think the temptation to think that bonds are a good buy here, that they're low price and that the yields of 5% are high, is wrong. I think bonds are still overpriced and yields are still too low, and I think they're going higher. Regardless of what the Fed does, with short rates, I think bond yields are ultimately headed a lot higher. And I think people in bonds are going to take significant losses, not just because the bond prices will go down, but because the value of the dollars in which those bonds are denominated will go down. So inflation is really going to destroy the value of bonds. And I think people buying them are making a mistake. They should be buying inflation-resistant type assets. So rather than bonds, they should be buying dividend-paying stocks, stocks that represent good value. So you're not buying for hype and momentum, but you're buying into a business that provides a good cash flow for you now and which can raise the dividend because they can raise their prices in line with inflation. Because when you buy a bond, you're stuck with that coupon. And so if the cost of living doubles, your bond coupon remains the same. So that's basically like losing half your money. But if you invest in a stock that's selling a product where the company can double the price of that product if inflation doubles the price of everything else, and then it can double your dividend. So you can at least try to stay even with inflation if you are an equity investor in a company that has pricing power.
Another side, China is selling U.S. bonds and buying gold. The rise of Swiss franc has been more pronounced than the rise of the U.S. dollar after the Middle East conflict. Could this be a sign of the weakening status of the dollar as a safe asset?
I think it is. I think you're seeing the early stages of de-dollarization. I think central banks are, voting with their feet, and they're selling dollars and buying gold. And they're rejecting the dollar, and they don't care that they can invest those dollars in treasuries and earn 5%. They recognize that inflation is going to be much higher than that, and so they're buying gold. Even though gold doesn't have a yield, gold won't be debased the way the dollar will be. And so you're seeing central banks moving some of their reserves from dollars into gold, and I think they're going to be increasing the pace of that rotation in the months and the years ahead, despite the fact that the gold price is going to be rising.
Let's make it simple. Do you have your own answer or theory why China is selling U.S. bonds and buying gold?
Well, yeah, because they're smart. That's what I would be doing if I had U.S. bonds, but I don't. And, I have gold. I bought more gold stocks the last time they had a big dip a month or two ago. But I think China can read the writing on the wall. They in a way, are put the writing up there. But they can see our trade deficits exploding. They can see our budget deficits. They can see that the U.S. is insolvent and has no chance to honestly repay its bills. They know that the U.S. is going to resort to inflation and that they're going to take huge losses on their U.S. dollar holdings. So rather than just wait for those losses to materialize, why not mitigate them now? Why not reduce your exposure to dollars and treasuries and buy gold? Because as the dollar weakens, gold is going to strengthen. And so they can make up for some of the losses on their dollars with the gains on their gold.
You just said you bought gold 2 months ago. Am I correct?
Well, gold stocks. I bought some more silver a few weeks ago, but I've been putting my money in the mining stocks because I think it's the best way to buy gold right now because you're buying the gold that they have under the ground. They haven't mined it yet. but you still own it, but you own it indirectly by being a shareholder in a mining.
What if individual investor wants to buy gold-related asset? What would be a good strategy for now?
Well, you could buy any of the major gold mining stocks. If you want to be a lower risk trade, you could buy the royalty companies. If you're more aggressive, you could look at some of the junior miners. You can go to our website at europac.com. We have some strategies, some separately managed accounts. We do manage money for customers around the world. So if you're not really sure which stocks to buy, talk to one of our representatives at europac.com, and we can help you pick the right stocks. We can manage a portfolio for you in mining stocks.
You're also famous for your belief in gold. What is your methodology for predicting gold prices?
Well, gold prices are going much, much higher. I think my short-term target is 2,500. We're about 2,300 now. We got above 2,400, and then we pulled back. But I think the next target is 2,500. And then beyond that, probably a nice round number would be 3,000. We could get there before the end of the year. We'll see. But I think if we don't get there in 2024, I think we'll get there and then some in 2025. I think this is a big bull market. It's got a long way to go. I think silver is going to catch up and outperform gold. So that's another metal that you could buy. We deal in both of those metals that shift gold. So if you don't have enough physical gold, I would suggest you buy it now before the prices go up.
2,500 in short term, then what we should check is how long is a short term?
That's kind of where I'm looking for the next stop.
While the Middle East conflict eased and there was a reversal, the decline of gold prices, could gold prices still rise after the conclusion of the Middle East conflict?
At the margin a little bit, the same with Ukraine. But I think the primary driver of gold prices is monetary policy, is rates are too low around the world. All the central banks created too much inflation. And all the big governments, the Western governments, have too much debt. And so the inflation problem is going to get worse. And so the solution, at least from an investor's perspective, is to buy more gold. And from a central bank's perspective, is to own more gold. So gold is going to continue to be bought at higher and higher prices.
And it's known that there's a lot of interest in silver along with gold. What is the reason silver is called next gold?
Silver has also historically been a monetary metal, and people do also buy silver when they're losing confidence in fiat currencies and when they're looking for an inflation hedge, store of value. So I don't think there's going to be anything different this time. Maybe silver won't do as well as it's done in prior bull markets, but it could still do better than gold from here. So if gold goes to 3,000, it's about a 50%. Or not even a 50% gain anymore. It's like a 20% gain, 25% gain. But I would expect silver to at least hit 50 if gold's at 3,000. And so that's a much bigger gain because silver is about 28 right now.
Are you still skeptical about Bitcoin?
Well, I'm not skeptical about it. I know it won't work. So it's not skepticism. I understand that it's not digital gold. That's just the con. It's a Bitcoin, not a Bitcoin. It's not even a coin. That's part of the con. But I recognize that the price has gone up. A lot of people don't understand it, and they bought it. But I don't expect the price to stay up. Ponzi schemes, pyramid schemes, chain letters, they can work for a while, but they don't work indefinitely. That's why they're illegal. So the Bitcoin Ponzi pyramid will collapse at some point. I still think there's a good chance that we've already peaked out, even with all these new ETFs. They haven't driven Bitcoin to a new high in terms of gold. It's still better than 20% below its 2021 high. And in fact, even in dollars right now, Bitcoin is still below the 2021 high. It got above it briefly, but it didn't stay there very long. So we really haven't made any progress in the last 3 years at Bitcoin, despite an unprecedented amount of hype. Before the ETFs, we had a major push with NFTs in El Salvador, and Michael Saylor's MicroStrategy, and Super Bowl ads, and nonstop pumping by the media. Yet they haven't really moved the needle much on Bitcoin. It's been stuck. It's gotten up into the upper 60s, low 70s, but it's not 100,000. It's not 250,000. It's not going where any of these so-called experts have been claiming it's going to go. And I think it's setting up for another big drop. The question is what will happen after the next big drop? Because so far, every time Bitcoin has crashed, it's come back to life. Right. Now, I think eventually it's going to crash and stay dead. So we'll see.
If institutional funds flow in through Bitcoin ETFs, could it be argued that future downturns might be less likely?
Yeah, it depends on if they buy and how long they hold. They may turn around and sell. In fact, I think the big problem for Bitcoin is going to be the ETF selling. I think that's what's going to spark the next crash. There's going to be a lot of the money that jumped in on Bitcoin. They're going to leave because these are not diehard Bitcoin maxis, true believers. The money that flowed into these ETFs, these are people who bought Bitcoin for the first time. So, I mean, if they were really into it, they wouldn't have waited for the ETFs. They would have bought it years ago. But they bought it, they got suckered into the hype, and they're expecting big returns. And when they don't get them, if the market turns south, I think they'll cut and run. I think, when Bitcoin starts trading below 50,000, I think a lot of the people who got in are going to want to get out. And that could be a real problem because the market could completely collapse because I don't think there's enough liquidity to get them out. I think it was one thing to get money into the ETFs. It'll be a whole nother thing to get it out. Because to get it in, they just needed people who owned real Bitcoin who wanted to sell it. And I think there's plenty of people who wanted to unload Bitcoin on the ETF buyers, and they did. But when the ETF buyers want to get out, I don't think there's enough money that wants to buy those Bitcoin back. Not at these prices. I mean, maybe if the market crashes, maybe if Bitcoin is back down to 10, 20,000, some of those guys that got out at 60,000 will want to get back in. But I don't think they want to get in at these high prices. So, you live by the ETF, you die by the ETF.
As we know, your son is one of those Bitcoin maximalists. Have you talked to your son with this subject recently?
He's kind of lost interest in Bitcoin. He was interested in it for a while, but now he's just more involved with AI. And so he has a whole different mindset, and I guess he doesn't see a reason for Bitcoin or gold. He thinks he just thinks that AI is going to save everything, and that we got nothing to worry about. So I think he's being very Pollyannish there and idealistic, the same way he was with Bitcoin. He's young, he's only 21 years old, so he jumps to a lot of conclusions and makes rash decisions. He hasn't even graduated college yet. He's still he'll have one more year after this year.
That's all for today's interview with Mr. Peter Schiff. Thank you for your time and insights.